Investing in the stable UK property market from overseas locations like Asia, Africa, Europe, or the Middle East is a smart move. But paying the additional 2% surcharge on your stamp duty, navigating 12-hour time differences, as well as making sure you're tax efficient can be very time consuming and means you need to invest in the right properties. In this video, I'll take you through a 3-step execution as someone based overseas investing in the UK market so you can maximize the returns on your investment and ensure you're set up in the right way. To be clear, this isn't a beginner's guide for expats investing in the UK market. I have done another video on that, so if you are just starting out on your research, I'd look at that video first and then come to this later. But if you've already done your research, you know you want to invest in the UK market and you know how it works, here's to maximise the success of your investment. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners, but this channel is all about your education. If you like the video, don't forget to hit the like button and subscribe to the channel, but let's get into it. So before we get into what we need to do, we need to identify possible problems you could have as an overseas investor investing in the UK market. The risk can be broken down into 3 main parts: the tax liability you have as an overseas investor investing in the UK market, the due diligence headaches that can be caused if you don't have a proper process in place to do your due diligence without stepping foot in the properties, and finally, the management nightmare that can arise if you don't have the right setup with your management company. Over the next 5 to 10 minutes, we'll talk through each of these steps, how to mitigate those risks and maximise the success of investing in the UK market. The first step, and probably the most crucial, is securing your financial structure before you buy. This is the tax implications and the financing. First, let's look at tax. Non-UK residents are still liable for income tax on your rent, capital gains tax on the sale of the property, and even inheritance tax. The solution to this is to speak to a qualified tax accountant as early as you can do before you invest in any property. They'll talk you through the most tax efficient ways for you to set up now, but also talk about your future plans, because if you ever plan on moving back to the UK and owning those properties then, your implications may be different, so it might be best to set up in a different way. You'll then be able to structure the purchase in the best way for you so you can optimise capital gains tax and potential inheritance tax. Secondly, you'll need to get a handle on your financing, so i.e. using a mortgage and the cost of leveraging. Because you're based overseas, you'll have less lenders available to you when getting a mortgage. This means that even if you're a UK national but based overseas, you'll have to either have a higher rate on your mortgage, or you might have to put a slightly bigger deposit down than 25%. That might only be 30%, but some international investors choose to put 35% down to make sure their rates aren't too high and the properties they're purchasing will still cash flow well moving forward. Before you start Googling lenders for overseas investors, your best next step is to speak to a specialist mortgage broker that understands that you're based overseas and the options you have available to you. To be clear, not all mortgage brokers will be familiar with this situation. A lot of mortgage brokers only work with UK home buyers and aren't familiar with the whole market in terms of investors and international investors. This means that whichever broker you choose to use, you need to ensure that they're familiar with overseas investors and that they have access to the whole market of lenders rather than just a portion of it. This will make sure that you have the best rates available to you and the best options available to you when securing finance when purchasing your property. Step 2 to maximising the success of your investment in the UK market is to delegate your deal sourcing. You need to make sure that you're buying the right asset in the right location, and you're essentially delegating your eyes and your feet to a trusted partner who can do this for you because you're not based in the same country. Part 1 of this is the location filter. You can't just buy it in London because it's where you're from or it's where you come to when you visit the UK. You need to make sure that you're investing in locations that's backed by data in areas primed for long-term growth. You need to look at regional areas like Manchester, Birmingham, Nottingham, Sheffield, Leeds, where institutions are investing significant amount of money in and independent companies are projecting growth of 18 to 25% over the next 5 years. Another big reason why these locations are likely to outperform the south and southern regions in the future years is because of the lack of affordability down south. These other locations, although they're getting massive institutional funding across these regions, they're still affordable for the local people that live there, which means demand is high and prices will continue to rise. This means that not only will you have better growth moving forward, you'll also get better yields because prices are a lot more affordable and rents in London don't reflect the purchase prices. Part two of delegating your deal sourcing is the deal verification. Professional due diligence isn't just going and trusting what a developer or an individual estate agent might say you can get as a rental income. You need to verify this with local agents who know the market inside out. You'll then need to calculate your net yield and your rental ROI to make sure that you're still getting a decent return, even with the additional 2% surcharge that you'll have as an overseas investor. And ultimately, the best way to maximize the success or trust this situation is to use a local buyer's agent who can get the good deals for you and make sure that they share as much information with you so you can go away and do your due diligence without having to step foot in the property. This is actually something we do at Freighter Property Partners, where we help individual investors purchase properties without having to step foot in any of the properties that they see. And if you'd like to have a quick chat with one of the team, I'll put a link to our website, Freighter Property Partners, in the description, and you can book a call there. The final step to making sure that investing in UK property is hands-off moving forward is to eliminate the management burden. There's two main ways you can do this. The first is to buy the right asset. What I mean by this is distance amplifies management burden. You don't want to be buying old properties that have lots of problems or could have lots of problems moving forward. Get good quality assets direct from developer that come with build warranties, that have less of a chance of things going wrong, so that maintenance is mitigated. Avoid high-touch HMOs that take loads of management or complete refurb projects. It's not the way to go as someone based overseas. Instead, focus on quality developers, whether that's city centre apartments or houses. Make sure that you're securing quality assets from quality developers to mitigate that risk moving forward. And finally, the second part is the management file. You shouldn't just appoint the cheapest property manager that you can find in the local area. You need to make sure that you're working with a vetted one that will manage the property properly moving forward. This means that they must offer quick communication with tenants and make sure that if there is any maintenance issues, that these are dealt with quickly. In the 2026 market and beyond, property management is going to be a massive part of the success of property investing moving forward because of the changes with the Renters' Rights Bill and renters having to have things managed and dealt with really quickly. This means that for you as an overseas investor, you need to appoint the right management company. Use recommendations and vetted experts to make sure that you can continually invest in property in a way that's hands-off for you and you don't have lots of headaches with management. To conclude, to achieve truly passive income from UK property while you're based overseas, you need more than just money. You need the system set up in the right way so you can continue to scale your portfolio, whether that's in the UK or globally, and continue to be a hands-off property investor. If you're ready to deploy some capital in the UK market and you don't want to have to fly here every time to look at a property, then I'll put a link to our website, Freighter Property Partners, in the description, and you can have a free chat with one of the team to see how we help our overseas clients. Our process helps with exactly that. We'll recommend tax accountants, mortgage brokers, letting agents, and solicitors to help you every step of the way, so you never have to step foot in that property if you don't want to. But that is it for today's video, so I hope you've enjoyed it, and I'll see you soon.